All right. Welcome everyone to this new episode of Ab India Karega Invest. Like every week, this Friday evening, we have got another topic for you on the public demand, and we will be very soon joining by a guest speaker from the mutual fund community. So I again welcome all our viewers to this new and exciting episode of Ab India Karega Invest. Last few weeks, I think we've been talking about asset allocation. We've been talking about equities, and as all of you are aware, that equity markets close to all-time lifetime high. Now, this is the time when we need to understand that markets cannot remain at these levels forever. Markets, by its true nature, will have some amount of volatility, and as smart investors, we need to work before markets work. So with that, keeping that in mind, we have selected today's topic, which is how can debt funds protect our portfolio's downside risk. Now, I know you might say that when equity is doing such a great thing, why we need to have debt talking at this point in time. Guys, trust me, with my 15 years, 16 years of experience into the markets, I have seen 2008, and precisely these are the time when, as investors, we need to be ready for volatile times. We don't know when they will hit, but if as investors we are ready for them, our portfolio will do good when again markets will rise after the volatility. So with this, what I'll do is I'll share a small presentation just to set the tone, and then our guest speaker will be joining, who will give in-depth perspective on how you can utilize debt funds, what are debt funds, where do they invest, and how as investors you can utilize them in your portfolio to protect the downside risk which may come in future. So very quickly, I'll share a small presentation and then I will call the guest speaker. So as I told you, how debt funds can protect your portfolio's downside risk. See, we all know that equity is exciting. All of us are very, very interested to make the upside potential which it gives to us. Yes, it is one of the best asset class in long run. It has the potentially to give or outclass every other asset class. But we need to be really, really cautious for the short term and the medium term, because it comes with its own sides of volatility. So if I just give you a historical perspective, how equity markets have done from 2006 to 2020, if I take last 15 years of ups and downs of the markets, there were years when market has doubled investors' money in just 1 year, 99-100% return in just 1 year. But we also had seen years when investors have lost 50% or slightly more than 50% of their capital. So this calls for us to be more protective when markets are doing well, so that we know that we are not woken up with a shock early in the morning when markets stumble. So just to give you a perspective, risk and return go hand in hand. Volatility, whether it is equity, whether it is gold, real estate, or any other asset class, every product comes with its own risk and return reward. So as investors, it's very, very important that we understand the asset classes properly and try to select asset classes which have negative correlation. And one asset class which fits the bill perfectly with equity is debt. So if you see the chart here, where equity, the blue line, you will see like a zigzag, which has given very high return some years and low returns. Whereas the orange line, not very, very, it may not look very, very interesting, but the most important fact which we need to pick is the consistency with which it gives you the return. So I think last 15 years, one thing which I have understood is that diversification is something which you cannot do away with. And especially this is a message for a lot of new investors who are seeing us and who have started investing in last few years and who have seen only the rosy side of the markets with portfolios doing good. Please understand that investing is not about one fund or one asset class any point in time. You need diversification in your portfolio. And for diversification, when I say it needs to be meaningful diversification. We need to know why we are adding any particular component in our portfolio. So just to talk a little bit about debt funds, historically, this is the product which has given very, very consistent returns. So somebody who's looking at consistency, somebody who's looking at protection of capital, this fits the bill perfectly. So a small question, I think, where equity markets looks very exciting, but it comes with its own volatility. But at times we need something which may sound very boring, but has the tendency to being very, very consistent. So we know in the game of cricket also, every player have its own role to play, and how consistent players have done well. So with keeping that in mind, we need to understand what are the asset class which we can bring in. And now with fixed deposit giving sub 4% return, investors are also looking out in fixed deposit or in similar risk profile, what are the options which we can invest in, which will make sure that our portfolio is ready for our short-term and medium-term goals, and it protects the downside risk, so that equity, when they do good, they can actually bounce back with the support of this particular asset class. So the answer is very, very clear. Debt funds, it needs to have in every portfolio. There are a lot of misconceptions which our guest speaker will try to break, that debt fund is only for senior citizens or people who are older in age. But trust me, why we need to have debt funds? Because one of the primary reason is it has negative correlation with equity. So when equity markets don't do good, we have seen debt market raises its hand and say that, okay, don't worry, and I will protect your portfolio. And compared to equity, the amount of volatility which a debt fund goes through is considerably lower. That means your portfolio risk graph is very, very lower, and perfect for capital preservation, which may be goals for some of you. If once you build a capital, it's very important that how you can preserve. So debt funds are answer for that. And there are goals for which we need regular income. So there also debt funds can come really, really handy. So with this, just a small background, I will not waste too much of time, because we have with us our guest speaker, Mr. Akhil Mittal, who is the senior fund manager from Tata Asset Mutual Fund. And he will be taking us through today's topic. And I'm sure with his experience, with his guidance, all of you are going to love this session. And please take notes so that you can utilize that in your portfolio to make sure that how you can protect your portfolio from downside risk. So over to you, Mr. Akhil, to take it from here.
Hi, thanks, Rishabh. Good evening, everyone. Akhil Mittal here. Just give me a moment. I'll share a slide, please. Rishabh, is this good? Is this visible?
Perfect, sir. You can go ahead.
Thank you. So good evening, everyone. My name is Akhil Mittal. I work in the fixed income investment side at Tata Mutual Fund. As the topic for today, importance of debt funds and riding market volatility. I would go one step back and say it's not only market volatility that calls for debt funds or calls for diversification in your portfolio, in your asset classes. It's the entire life cycle of investments. The life cycle of investment would start as early as you start earning and go all the way till you consume those funds. Now what happens is different stages of life, you would have different priorities, different levels of earnings, different levels of expenditure, different levels of consumption. So when earnings, consumption and capital, future capital need is not the same, how can investments be only in one asset class? Your investments have to be diversified in such a way that your differential earnings or differential consumption or future consumption is taken well care of in a large probability zone. So what happens is Yes, we all know that, in longer run, equity markets have performed and tremendously well, and they are good asset class. But it also means that, there is uncertainty with respect not only to market. Now, step back and think if there is uncertainty regarding your earnings. At that point in time, what is the comfort zone that one would invest only in, let's say, a equity market or commodity market or physical assets like real estate? Or let's let's take another scenario. You want to save funds for any particular objective. Let's say 5 years down the line, you want to buy a house. uh, how much of your money can you put at risk? Because equity markets or commodities, different asset classes have different kinds of volatility therein. So when you know there is a particular need of a particular sum of money after a particular time, you would always tend to keep a margin of safety so that the probability that you will be able to service that particular objective is high. So you don't want to keep your money in volatile asset class wherein your money can go down, and then might be a case that you can't service your objective. So that is not desirable. Hence, in the entire life cycle of investments, it is important to diversify, especially when it comes to volatile market cycles like what we have seen in last 2 3 years. We started with the sideways movement of equity markets, then we had pandemic coming in, markets crashing, then we had like a never seen before euphoria. So these are volatile times, whether the market goes up or goes down extremely high or below, or lower than long term averages, it is called volatile times. So in volatile times, it becomes all the more necessary that we continuously relook at our portfolio, relook at our wealth, relook at our objectives, and then see if everything is stacked up nicely. So then comes the question, what are fixed income funds or what are debt funds? Debt funds are basically funds which invest in fixed income securities. Now, what are fixed income securities? Like fixed deposits, there are securities which have a fixed coupon or a fixed repayment maturity principal, or both. These are called fixed income securities. So what do they comprise of? Number one, a fixed coupon. What is coupon? Let's say 5% is the coupon. That means periodically that security will pay you 5% coupon, 5% interest in your account. Then the second part, which is fixed, is tenure. When you buy a fixed income security, you know the tenure of the security, whether it is 6 months, 1 year, 2 year, 3 year, 5 year, 10 year. So the tenure is fixed. You know your repayment amount, you know your maturity amount. When the security matures at the end of the tenure, what is the cash flow that you are going to get? So there are three things very certain: coupon, tenure, and repayment amount, which basically means that your earnings, your visibility of regular earning is very clear. Your visibility with respect to tenure, how long does this investment last, is very clear. Your visibility with respect to money inflow, that is very clear. So what does it reduces? It reduces uncertainty of income. It reduces uncertainty of time. It reduces the uncertainty of the future wealth. So that is a fixed income security. For example, we buy a 5% coupon of ABC company for 3 years. It basically means every year, next year, year after that, the company will pay me 5% fixed coupon. And at the end of the tenure, the company will pay me my original principal amount plus 5% coupon. So these things are very clear. So how does this benefit us? Number one, let economy go wherever it does, as long as the company is solvent, as long as the company is operational, we will get our coupon, which is fixed. We will get our timely payments. We will get our repayment. So the question of market cycles or economic cycles is to a large extent taken away. Now, how does this benefit as a to one as an investor? So let's say, as example given, let's take for example a 50-year-old guy who is going to probably retire after 10 years. Now, for him, after retirement, what is necessary is a regular cash flow through which he can survive or he can sustain his lifestyle for the remainder of his livable life. So for that, he would need a very big clarity. Now, you don't want to be in a situation wherein, fine, I will take additional risk. And God fear, hypothetically, the market tanks, equity market tanks. Then what happens? The person has no money to survive. So as your life stage differs, as your earning differs, as your consumption cycle changes, you need to change. So debt funds play an important role at every part of life cycle. It is not only at the retirement age or close to retirement age, as Rishabh had said. Suppose a 25-year-old guy starts wants to buy a house after 5 years. He has 80% of the money, but let's say he can buy after 3 years, after 5 years, whatever time. Can he afford to put his 80% of the money in, let's say, equity markets or a commodity market? The answer is no, because there is a risk that that might go down. Now, what happens in a fixed income security? You know that your principal amount that you're investing is going to come back. Is the same surety given in other asset classes, let's say equity or a commodity? No. Your 1,000 rupee share can go down to 900. So that way you will have a capital erosion. But in case of fixed income securities, that does not happen. So an investor has visibility of cash flow, has visibility of return of money. So that is how it benefits investors. Now, who issues these fixed income securities? Corporates, banks, government of India, PSU enterprises, municipal corporations, almost any entity, they issue fixed coupon bonds or fixed income securities. And now there can be different types. I don't want to go really too deep into what are the kinds of fixed income securities, but just to touch base, there can be zero coupon securities, there can be floating rate bonds, there can be fixed coupon securities. So the idea is that there is a regular income which is defined at the start of investment cycle. There is a defined investment tenure, and there is a defined maturity amount. So when it comes to which kind of fixed income securities you can invest, you have a wide array of issuers, ranging from government to state governments to PSU entities to state government entities, private corporates, NBFCs, housing finance companies, municipal corporations, almost all the parts of economy, all the companies involved in the economy, almost all of them issue fixed income securities. So you have a wide variety, wide array spread across sectors for issuers who can, issue such security. So what happens? How do you analyze a security? When we say, there's a government security or a private sector security, what is the first thing that you look at? While investing in a fixed income or debt security, the first thing that one looks at is the safety. What is the safety that my money will come back? So does investing in a HDFC Bank FD or a PMC Bank FD mean same? No. So what was the difference? Both were fixed deposits, both had a particular rate of interest. What was the difference? The difference was safety of the issuer, safety of the bank. Now, how do we see the safety of the bank? Well, there can be, as we at institution level do detailed credit research due diligence, but prima facie for a reference purpose, one can always refer to credit rating systems. So rating agencies like CRISIL, ICRA, India Ratings, CARE, they issue ratings which are credit quality, which denote the credit quality of the issuer. So government of India will have a sovereign rating, the best PSUs or private companies will have AAA rating, then there will be AA plus, AA, and so on and so forth. Basically, these denote that the probability of servicing your instrument and returning your money is very high, high, moderately high, average, below average, so on and so forth. So basically, it means you have the option of even choosing the safety when it comes to choosing the issuer. Now, then the question should arise, why would anybody choose a lower safety issuer? Everybody should go in for the higher safety issuer. Over there, the difference is the coupon rate. So going back to HDFC Bank and PMC Bank example, HDFC, hypothetically, if it was giving 6% on FD, PMC Bank would have been giving 8% on FD. So the difference was that additional 2% return, which meant that a particular set of investors did find 8% more attractive than 6%, and they took that risk. Not all lower rated entities default. In fact, the default ratio in India as a country, or especially in capital markets, is very, very low as compared to rest of the world. And the basic idea is, at the end of the day, we should be able to invest in a portfolio, pick up securities which we know do fulfill our objective. If our objective is 100% safety, we go for highest credit rating. If we want safety plus a little bit extra income, we might look at others. So what denotes all this is credit rating. So most of the fixed income securities have a credit rating. Now these credit ratings could then tell you whether the issuer is safe, lesser safe, and so on. Now comes fixed income securities are volatility is much lower. As Rishabh had shown in the previous presentation that he had put up. Now, what is volatility? How do we define volatility? Volatility is basically movement away from normal course. So without going into mathematics of it, if you have a normal course, a normal pattern, a normal behavior, the movement away from such normal behavior is called volatility. You would have heard in some movies that his behavior is very volatile, or let's say markets are very volatile. So what does it basically mean? Does market and behavior are both measured at same standard deviation? No. It's basically, simply put, movement away from normal pattern. So if, let's say, a normal pattern of economic growth is 8%, your equity markets would go up sometimes by 15%, go down by 5%. Or let's say a fixed income market, fixed income securities, which is going to pay you fixed coupon. Though there could be MTM because of duration, but that MTM will still be very, very low. It is not going to take you to plus 15, minus 15. So the volatility or movement away from visible pattern is much lesser in fixed income or debt funds, and hence the comfort, what we call as, you invest in debt funds and you can sleep peacefully. That is because the volatility is lesser. You won't get a exciting shock every day morning that markets have gone up or markets have gone down, and then you go back and see what is the impact on my investment. That impact in debt funds is much, much lesser as when it comes to comparing with other asset classes. Now what does fixed income or debt funds also mean? Once you start creating a portfolio, when I say a portfolio, it doesn't necessarily mean only one particular asset class or one particular type of instrument. When you create a portfolio, let's say if I'm creating a portfolio for myself, I would put equity mutual funds, I would put some physical assets, I would put some uh, debt funds, I would put some FDs. So all these instruments put together will make a portfolio for me. Now, when I make this portfolio, that point in time, three things which I will start looking at is: number one, what is my age, current age, what is my earning pattern, what is my consumption pattern, and how much money do I need at different periods of time for my obligation. So let's say I'm 40 years and I know after 10 years I will need money for my kids' education. Well, that is a non-negotiable thing. And I would not want to compromise on that. If I have a particular college, or if I have a particular quality or a significance of institution in my mind, I would ensure that I meet that obligation. I would want to reduce the possibility that I'm not going to meet that obligation. So if hypothetically saying a IIT degree for 4 years is going to cost 40 lakhs after 10 years, then I need to have that 40 lakhs fixed, guaranteed at the end of that tenure. I do not want a scenario wherein, at that point in time, I don't have the money to service. Or let's say I want to buy a house after 5 years. Or let's say I want to retire at 55. And when I retire, I need two things. Number one, I need a regular stream of income which is going to run my house. Secondly, I want a corpus of money which is safe, which can be used for any medical emergencies or any other emergency that I need. At that point in time, there has to be a probability that I'm going to meet it. So how do I do it? I can do it only with asset class where there is visibility, and that is fixed income or debt. Now these are considerations, why one should look at debt funds. Now comes why debt funds in volatile time periods. uh, Rishabh has also mentioned, and go back and think of times like 2008 cycle. We saw a global economic meltdown. At that point in time, I remember equity markets were down some 50-55%, if I'm not mistaken, in a couple of months time. That point in time, now one can always say, I will not redeem the money when the markets are down. So that is another question that comes. So let's say if your obligation was due then, if your son's college fee was due when market had tanked, what would you have done? Or on the other side, let's say in 2013, RBI had raised MSF rate by 300 basis points, and the interest rates had gone pretty high. The markets had tanked then also. So what do? Uh, either either you book the losses and try to sell off some other asset or dip into your other savings to meet your obligations, or while in the first place you know that you have a fixed obligation, you know there can be volatility in the market, what would you want to do? You would want to reduce the volatility. So one thing which I like to tell most of my audience is, one should never gun or never run for highest return. uh, Highest return would mean highest risk normally. One should always see what is the return one wants. Now I would want highest return, I would want 50% return, but what is the probability of me getting that return? That is how one should take the decisions. If today I have to invest and I say I want 15% return, what is the probability of me getting that 15% return, and what is the asset classes that I'll have to invest in? If the probability of getting that 15% return is 30-40%, and the probability of getting 12% return is 70%, and probability of getting 8% return is 85 or 90%, that is the question one has to answer. You want surety, you want a visibility as to what your hard earned money is going to make you. It's never about chasing one side of returns. It gets lots of risks in. I'm not implying anything on markets. Markets have their own momentum. Markets have their own way. They keep going up, they keep going down, they move in cycles. But how does one then ride across? Can one choose or be wise enough to invest at the lowest point in time and redeem at the highest point in time? I don't think so. It's not possible for normal investors. So let's see this. So this is how the blue line is. I've just taken a CRISIL index of short-term bond fund, and I have plotted your Nifty 50 on that. Now, this is the kind of volatility that you see in equity markets vis-a-vis the stability of fixed income. Equities would have given much higher return. That is because the asset class has much higher risk. So it should deliver higher returns. But then there are cycles, there are bouts wherein those kinds of returns can be momentarily or for a time period wiped off pretty significantly. So whether I put all my eggs in a particular basket, whether I put half of them, what is the proportion of my investment? My proportion of investments will change with your age, will change with your earnings, will change with your consumption cycle, will change with your objective. Hence, an advisor can probably advise you if you have one, or for that matter, you can sit down and jot down your own details and then take a decision as to, one thing has to be very certain. Well, everybody likes high wealth, but at the same time, it's important that one has to be able to meet his obligations or his wealth targets. So I've just plotted returns. So let's see Nifty 50 returns in a particular financial year vis-a-vis debt fund returns in those years. So you see, let's say FY20, FY16, FY12. I've just taken last 10 years. Uh, there has been significant downside in equity markets, or let's say FY21, phenomenal return year, FY13, low return year. So at the same point in time, look at the right hand CRISIL short-term bond index. Well, the returns are largely positive in nature. There might be 1-2% here there. There are some extraordinary good years. There are average years, and there might be one of a low return year. But at any given point in time, you see the volatility or the deviation from the normal zone is much lesser in case of debt funds. So there are various kinds of debt funds. Then the next question which should come to your mind is, while creating my own portfolio, then what is the proportion that comes into fixed deposits? Or it should start that way. Firstly, you should ask, what is the debt component of my overall investments? Once you know that, let's say 50% is your debt requirement or fixed income requirement, then you have to go back and see what are the various options within the debt category. There could be fixed deposits, your provident funds, mutual funds. Then comes the question, how much in mutual funds and which mutual funds? Now, it's easier said that one should invest in debt mutual funds. But which debt mutual funds? Debt mutual funds, unlike FDs, do not guarantee returns. They are subject to market volatility. They are subject to interest rate risk. Now, what is interest rate risk? Now, every paper has either tenure, or what we call as a modified duration, which basically means higher the tenure, higher the risk. So how it goes? Let's say today repo rate is 4% and 10-year GSEC is at 6%, hypothetically. After 6 months, the repo goes to 4.5. At that point in time, 10-year GSEC most likely will be at 6.5. If you had invested at 6%, then that means over the period of the tenure of the bond, you will earn only 6%. Whereas somebody who invested after 6 months is going to get 6.5. So your earnings will be lesser than the earnings of the second person. That is the difference, that modified duration creates. Now, the volatility is there in debt funds also. Now, there are various kinds of debt funds. The debt funds range from overnight fund, liquid fund, ultra short, all the way to gilt funds, banking securities funds. Yeah, there are different. There are varied classes of these funds. Now, which fund to choose? Now that comes, oh wow, we were just still contemplating across asset classes. Suddenly, we've kind of made our mind, okay, we'll invest in debt funds, but now, oh my God, there are like 15 types of debt funds. Now, what do I do? Now, debt funds are basically, they carry two types of risks. So no investment is risk-free. What risk is there in debt funds is, number one, interest rate risk, and number two, credit risk. Now, easier one to explain is credit risk. What is credit risk? Whether your money will come back or not. It's as simple as that. So a fund, let's say, which invests only in a gilt securities fund, it invests only in gilt securities, sovereign securities. So it's sovereign risk. Your money is going to come back. Let's say credit risk funds. What are credit risk funds? Which invest in papers which are not prime credit quality. So your accruals, your returns could be slightly higher, but your safety of return of money is slightly lower. So similarly, you have your short-term funds, you have medium-term funds, you have long-term funds. So how to pick up the fund that you want to invest in? Number one, what is the tenure of your investment? So in the second column, if you see, we have written some recommended investment horizon. What is the tenure of your investment? If you want to, for example, if you want to invest for 1 month, 2 months, 3 months, you have your housing registry due after 3 months. So we are in July. In September, you have your housing agreement due. Can you invest in a gilt fund? I don't think so, because there is volatility. What you would want to do is safely park that money, let it earn whatever little it can, but you know that you have already written that check. That check is going to be banked after a couple of months. So the tenure of investment is the first thing that you start with. Number two, what is your risk appetite? When we say risk appetite, whether you are okay with a 5% return becoming 4.5 in pursuit of 5.5, or you say I want 5 plus minus 10 basis is okay, but I don't want 50 basis points of volatility. Let me explain that again. Let's say the coupon is 6%. Now you say, fine, what is a product which can deliver me 6.5? I'm not okay with 6. So the first thing which will come to mind is, let's increase the duration, because if interest rates go down, then probably I'll make 6.5. But at the same time, there is a risk that the interest rates might go up. So your 6 might become 5.5. So that is your risk perception level, whether you want a very high, close to your target return, or whether you are okay with taking a little bit of additional volatility or additional risk so that your return can be maximized. This is number two, your risk. Number three is safety that you seek. When I say safety that you seek is simply, uh, go back to the example of HDFC Bank and PMC Bank. Whether I want my money to be 100 rupees back, so I'm okay with a 6% return, or there is another bank which is giving 8% return. I think 95% probability that that bank will also return the money. So that is the safety side of it, whether you want 100% safety or you're okay with slightly lower safety. These are the three basic risks or criteria that one should consider before investing in debt funds. So there are, as I said, various kinds of debt funds. Platforms like Groww are technically expert at those. They will handhold you to choose, or in fact, it's easier now. SEBI has given riskometers, so all the products will have riskometers. You can go through those and choose. So if you want to invest for 6 months to 1 year, low duration or a money market category is good for you. If you want to invest in for 2-3 years, but you want lower volatility, you could go in for short-term funds. If you want to invest for like 3 to 5 years, you could go to for medium to long-term funds. If you want to invest for higher accruals, then you could go in for credit funds. If you are okay with lower accruals but you want high quality, you can go in for banking and PSU. So various options are available within the debt funds to choose with the economic or the interest rate cycle. Like economy passes through cycles, interest rates also pass through cycles. So we have lots of options within debt funds, primarily not only to choose against the asset class. So not only debt funds against equity funds or something like that, but also within debt funds, you see the economic cycle. So for example, let's say inflation is going high. So what would naturally happen if inflation is going high? The natural action would be the central banks would raise rates, and interest rates would go up. In such a scenario, you should not be invested in long duration funds, because there can be some bit of duration volatility. So within economic cycle, within interest rate cycle, also as against other asset classes, debt funds gives you varied options, varied choices to manage your complete investment portfolio. So that's broadly from my side. I think Rishabh, Shikhar, I can stop here, and you guys can take over from here. Thank you.
All right. Thank you so much. Hello, everyone. Welcome to AIKI. I will talk to you about the product that Groww is. And following that, I will be here to take your questions about Groww, the product that we have, and the future roadmap, and any other questions that you might have regarding Groww. I'll just quickly share my screen now. Akhil, can you stop sharing your screen? Yeah, thank you. Thank you so much. All right. All right. So as you know, when you are on Groww, this is how you start off. This is the first screen that you'll see on your app. Signing up is 100% paperless. It's very easy. It's very simple. It does not take a lot of time. Here's the old design and new design side by side. So this is the biggest change that I want to talk about today. It wasn't there a long time ago. What happened was we observed that as time is going by, we are adding newer products. We're adding new offerings on Groww. So the old design was better for maybe one or two products like mutual funds and stocks. And now we have several other products coming. And it just made sense to go with a design that is more optimized for different kind of investments. So the old design is all about the earlier products that we had, and the new design allows us room to launch and bring on the app many new products. So as far as I'm aware, in the Android ecosystem, everybody would have gotten this. If you haven't, you can just update your app and you will get it. iOS, we've started rolling it out, but it wouldn't have reached everybody as far as I know. If you have it already, that's great. But if you haven't, you'll get the new design very, very soon. There aren't any major changes. I mean, there is a major change, but it is one that you will easily get used to. And that is the home screen. So earlier you had an explore screen where you could choose between stocks, mutual funds, gold. And then you had the dashboard. Again, you could choose between stocks, mutual funds, and gold, but dashboard contained your investments. And likewise, then you had to go to you. But under the new design at the bottom, you have the different products. So right now you have stocks, mutual funds, and gold. In future, you'll have other things being added here. Now, in each of these tabs, like let's say you had selected mutual funds, inside each tab, you'll have the explore and dashboard tabs at the top. So everything else is more or less the same. It's just that this is the change that we've made that allows us to easily add newer products. So I just want to say this again. If you're too used to the old design, you might have a little bit of a very small learning curve. But as soon as you get used to that design, you'll realize that it's actually much better this way. At least that's what we've discovered talking to our users who have been using the new design. So this is what the mutual fund screen looks like. As I just told you, there's a top search bar where you can search anything, be it mutual funds, stocks, or gold, or anything else. The picture that you see on the right side of the search bar is what used to be the U button at the bottom. So whatever options used to get by pressing U at the bottom, now you'll get by pressing the picture on the right end of the search bar. Below that, this one is the mutual funds tab. In this, again, you have explore and dashboard. Likewise, you have this is for stocks and this is for gold. Now, the other pages, like for example, in this case, let's talk of the mutual fund page. In the mutual fund page, nothing has changed. You still have every possible information that you could need as an investor displayed here. And each of these pages will have very, very detailed info that every investor, I mean, whatever an investor might want to know, they'll find it here. So past returns, expense ratio, fund manager's name, other funds in that category, all of these things you'll easily find here. And likewise, the stocks page hasn't changed either. It's more or less the same. All the relevant details of a given stock you'll find here without any hassle. And likewise, this is the gold page, which is also largely unchanged from the last version that you would be familiar with. Another fact that I like to highlight a lot is that in every mutual fund, you have the option of investing monthly via an SIP, or you have the option of investing one time, which not many people know. You can invest one time in a mutual fund. You need not invest in a monthly format. Another thing that many people don't tend to know is if you have an SIP running in a mutual fund, you don't need to you don't need to worry about investing a single time. So if you have an SIP running, you can also invest one time in that same fund. And you also don't need to worry about how many SIPs you can start. So in the same fund, you can have 5 SIPs, you can have any number of SIPs you want to run in that mutual fund, and at the same time also do one-time investments in it. On the flip side, you don't need to have an SIP to do a one-time investment. If there's a mutual fund in which you have no investments and you want to do a one-time investment, you can. It's not necessary to do an SIP in that. This is the dashboard section. So in this particular picture, we are seeing the dashboard of the mutual fund tab. In this, you'll be able to see a list of all the holdings that you have. So in this particular case, all the mutual funds that you have invested in, you'll be able to see them here. If you tap on any mutual fund's name, an option like this will pop. In this, you'll have the option of investing more or redeeming, which is also known as withdrawing. The more details button at the bottom. If you click that, you will be able to see all your transactions in that mutual fund. So all the dates that you invested, all the dates that you withdrew money from that, your folio number, your average NAV, all of those details you'll be able to easily see. Likewise, like this is in this case, we're talking of the dashboard of the mutual funds product. Likewise, the dashboard for the stocks and for the gold products will also have all these relevant details. Moving on to import and switch. This is one of the more popular features that we have. Import allows you to move your mutual funds from another platform to Groww. Let's say you have some investments that you made via some other platform or via someone else, and you'd like to move them to Groww so that all your mutual funds are in one place. It's easy to track. It's easy to see the progress of. You can do that by importing them to Groww. Go to your mutual fund tab, tap on dashboard. Right at the bottom, you'll see the option of importing. So if you tap on that, then you'll have to follow a few simple steps and the importing will be done. Once you have imported, you have the option of switching. So when you invest on other platforms or via someone else, chances are that that investment would have taken place via the regular plan route, in which case you are paying a commission. Now, if you want to switch to the direct plan where you don't have to pay a commission, you have to first import the mutual fund to Groww. Once you've imported a regular plan mutual fund to Groww, you'll be shown an option to switch it to direct plan. And then you can easily switch to direct. So first you have to import and then you have to switch. And it's not necessary that you import and switch. If your mutual fund is already a direct plan, you don't have to switch. You can just import. And for whatever reason, if you want to import, but you don't want to switch, even if it's a regular plan, that option is also there. Switching is not mandatory. Groww Digest, daily and weekly. So this is a newsletter we send Monday to Friday and on Sunday. The idea with these newsletters is that it should impart the average investor, the new investor, about everything that he or she might need to know about the world of finance in the simplest, most concise, easy to understand manner possible. So you will not find heavy jargon. You will not find concepts that are difficult to understand. If there are concepts, we'll also be taking an effort to make sure that you understand what that concept is. It's all about making sure that as a new investor or as an investor who wants to keep his or her mental burden low, they should find this newsletter absolutely optimal. So Groww Digest Daily is basically market news and all other important parameters that you should be knowing every day. And Weekly Digest is all about going a bit further, learning a bit more. If you have any questions regarding anything, be it the product, be it your transactions or anything other than that, you can write an email to us at support@groww.in. Besides this, you can also go to the help and support section. And within the help and support section, you will be able to find the answers to some of the most common questions that people tend to ask us. Usually, you will find your solution there. In case that doesn't happen, in case you don't find your solution there, you can raise a ticket and reach out to us via email or via call or even via live chat. So that option is also there. Please do follow us on Facebook, Twitter, LinkedIn, and YouTube. Our YouTube is an extremely vast and resourceful location. It's, as a new investor, you'll get to learn a lot. Now we even have vernacular support. We support many other languages on YouTube also. So besides Hindi, we also have other regional languages, like we have Malayalam and we have Kannada, and so on and so forth. So if you are comfortable with a certain language, you might find one of the YouTube channels that we have very useful for you. We try to ensure that whatever content we put on our YouTube channel is very relevant to new investors, so that they can learn and pick up investing really quickly. With that, I come to the end of my presentation. Thank you for listening. And now we'll be joined by everybody and we'll take your questions.
Thanks, Shikhar. Thanks, Akhil. I think the way you shared about debt funds in such a simple language, I'm sure all our viewers would have now will be really well versed to start investing into debt funds for their portfolios. We have already started getting a lot of questions and we'll start taking them. In the meantime, I request other viewers, if you have any questions, you can drop in the comment box and our team will direct it to us and we will ask your questions to our expert today, Mr. Akhil. So I think the first question, Akhil, is which debt fund should we invest for a long term? Suppose I don't want to shift from product to product and I want to invest in just one or two products. So what kind of products would you suggest to our investors?
Sure. So if you're looking for long-term investment for debt category, I basically assume long-term as 3 years and more than that. So if you want to invest for a long-term, you have options like short-term fund, or let's say a medium-term to long-term fund, or you have something like gilt funds. Within these, you should generally go by what is your volatility appetite. So short-term funds will have much lower volatility as compared to gilt funds. Medium-term would have slightly higher than short-term. So all these 3-4 categories are good for longer term investments. If you actually plot the returns of these categories over a longer period, 5 years, 10 years, you'll find that returns are very nearby. There will be cycles when one particular as category would have outperformed the others, but on a longish time period, these categories return would be close to each other. So depending upon what kind of a volatility you can take, you should go in. I would generally say for people who would want lesser volatility, a short-term bond fund category or a banking PSU category, those categories are pretty stable categories.
Okay. Or they can also invest in a couple of them in a 50-50 or a.
Sure. I mean, you can pick and choose. In fact, there is a category called dynamic category, which changes its stance with changing rate cycle. In fact, that category has also performed very well over longer period of time. So you can pick or choose amongst these 2-3 categories, or you can actually mix your investments, break up your investments within these categories.
Perfect. I think you've shown different types of funds and liquid. I could see they're one of the product under debt fund, but still a lot of our viewers, they are confused as in what is the difference between a liquid fund and all other debt funds which are there. Yeah.
Sure. So liquid fund, basically, it's like money available without much risk. So liquid fund is a fund which invests only in up to 3 months of securities, up to 3 months of paper, which basically means the entire portfolio is made up of very, very short-term or near-term securities. When you have such short-term or near-term securities in your portfolio, two things are very clear. Your investment horizon is very short, and number two, the interest rate risk is going to be very less because the portfolio keeps maturing and reinvesting itself. So, but both these things will also mean that the return profile of liquid funds is much different than return profile of debt funds. So, liquid funds are basically for parking your very short-term funds. Let's say you want to do a STP in equity funds over a period of next 2-3 months. Liquid fund is a vehicle that can be used for that. Or let's say you need to park your money safely for 2-3 months. Liquid funds is basically a category which we call as temporary parking of funds, because before they are utilized in an organic form.
Perfect. And I think liquid fund can also be used for your emergency requirements. So if you
absolutely.
Okay, perfect. Now, I think one of the common questions, which I'm sure you would have answered a million times, and a lot of viewers want to know, debt funds versus FD. What are the parameters which we need to keep in mind before choosing, and how it is different?
Yeah. Okay, so yeah, answered many times, but let me try and give a different answer. A fixed deposit by nomenclature is fixed. You don't have a upside, you don't have a downside. You don't have an entry, you don't have an exit. Now come to funds. You have entry, you have exit, which basically means your funds available to you whenever you want without any penalty. So if you invest in a 5-year FD and you, God forbid, you need some money after 1 year. So what will happen? Firstly, instead of 5-year, they will give you a 1-year rate. And secondly, they'll put some penalty, bank will put some penalty, 0.5%, 1%, whatever. So you end up making really low returns. Whereas in a debt fund, if you need your money after 1 year, whatever it has earned in 1 year, that is yours. So two things come. Number one, exit cost in FD is high, exit cost in debt funds is low. Number two, liquidity in FD comes at a cost. Liquidity is lesser. So you would basically mean that, I need money, but should I break my FD? Or should I just let the objective go away? If you were invested in debt fund, you would not think that. You simply have to redeem and you can do your objective. So look at it at the way of exit cost, look at it at the way of liquidity. Returns, let me tell you one thing. When it comes to FD, it involves safety, or let's say visibility or certainty. There's no free lunch. All these come at a cost. So rarely you will find a cycle where FDs, longer term FDs, have outperformed debt funds. It happens in case of extreme interest rate volatility. It might happen for a couple of months, but on a steady state basis, that doesn't happen. So even on the return side, historically, debt funds have performed better. Coming to the next part of it, which is taxation, again differs from individual to individual, but I'm assuming, let's say, if we are in a highest tax bracket, debt funds are tax efficient. It's as simple as that. You do indexation, and long-term capital gain tax of 20% post indexation would hardly give you any income tax liability as compared to a fixed deposit, which will give you your marginal slab of taxation liability. So post-tax debt funds, definitely. Liquidity, yes, very good. Exit cost, very low. You participate with the economy. Always remember, in a fixed deposit, you have participated once and your returns and your compensation is fixed. Whereas in debt funds, your movement happens with the economic cycle, with the interest rate cycle.
Yeah, I think that's very, very interesting, that as economic cycle picks up, you get to cash on that economic cycle with debt funds. So that's pretty useful. Now the next question, very interesting, like what are the different types of risk which debt fund has got when compared to equity? Because equity, we know it has market risk of sectors. And so when somebody is looking to invest in debt funds, what are those 2-3 risks they need to keep in mind?
Sure. So as mentioned earlier, there are two broader risks, and then we can subset those. But the broader risks are, number one, interest rate risk. Let me define interest rate risk in empirical way. Interest rate risk basically means if interest rates go up, price of the fixed income securities goes down because there is an inverse correlation between yield and price. So which basically mean in a cycle where interest rates are going up, the price of our holdings would go down and hence returns would come slightly down. In a cycle where interest rates are going down, the price of securities will go up, and hence your return on debt fund portfolio will go up. So for example, 2020, you saw debt funds delivering 9%, 10% returns, whereas those were the not kind of coupons that were applicable then. It was basically because interest rates were going down. So interest rate risk number one. Well, interest rate risk is also there in equity markets, but it is an indirect risk for them, because if it basically means if interest rates go up, then cost of funding goes up, cost of capital goes up. If cost of capital goes up, then earnings of the companies go down. If earning of the company goes down, then your PE goes down. So it's a derived equation there, but directly interest rate risk and credit risk. Credit risk basically means whether the company's balance sheet, whether the company's standing is improving or it is going down. If it is going down, then your safety is going down. If the company's credit quality is improving, then your credit quality is going up. So it basically means safety of your capital. So those are the two risks one should typically look at while investing in debt funds. Regulator itself, which is SEBI itself, has imposed lots of prudential norms while investing in for debt funds, which is issuer level, sector level, security level in terms of listed securities, unlisted securities, credit complexity level. What kind of securities can you buy? What is the quantum of complex credit securities that you can buy? So regulator has itself put lots of prudential norms, but if you want to actually go beyond the normal course and see, there are things like diversification across sectors, single issuer limit. How much is a single issuer exposure that a particular fund is carrying? What are the various empirical ratios? You can calculate them. These are readily available. So those kinds of risks one can judge. What debt funds don't have and equity funds do have is number one, cyclical risk of earnings. A company could earn more. Let's say the EPS of a company, or there is a cycle where the couple of years where the company's earnings are not that great as compared to market expectations. So normally you would see the price of shares going down, but that doesn't happen in fixed income. Even if a AAA PSU entity earns 10% less profit, it's not going to change its credit rating or its cost of borrowing. So those kinds of risks which are associated with equity markets don't necessarily impact debt funds, and hence largely two risks: interest rate risk and credit risk.
Perfect. So interest rate risk and credit risk, as investors, I think we need to keep a watch. And talking about interest rate risk, I think which a lot of investors would want to know, what is the queue going forward? What is the direction looking like? What the governor is thinking? So what is your view on interest rates now?
Yeah. Okay, so if I look at the broader cycle of interest rates, one thing is very clear: we are past the easing cycle. We are past the cycle where where RBI would cut rates. When would the central bank cut rates? Basically, when inflation is coming down, and it gives space to the central bank to cut rates. When you cut rates, money becomes cheap, and then it helps the economy to recover. We are past that stage where inflation has gone up. Now, in India, there is a Monetary Policy Act which basically gives the Monetary Policy Committee a statutory target. Now, this is a target given by Parliament of India. It's a legal binding target, which is 4% on a medium term basis, plus minus 2%, which is a band which has to be given because no economy inflation can be controlled to the last cent. So plus minus 2%, that is the band given. Now our inflation for the last couple of months has been outside that band, which is above 6%. Hopefully it will come back to within 6. But the idea is, if your medium term target is 4%, and even on a normalized basis you are going to go 5.5, your inflation is going to be much higher. So your Monetary Policy Committee will have to address that. so that inflation can be controlled. But then there are external factors which decide when the Monetary Policy Committee does change the interest rate. So in current case, the external factors that are also affecting the monetary policy is supporting growth. Now, COVID wave 1 and wave 2 took serious impact and concentrations on the economy. So one of the important objective of a central bank is also to support the economy. Now, RBI has supported the economy since 2020 in three ways. Number one, cutting rates. Number two, increasing liquidity. Number three, regulatory leeways. So when we talk about what lies ahead, one should look at all three in totality. I think on the monetary policy cycle, interest rate setting cycle, RBI would want to be more sure that whatever steps they have taken in the last 1.5 years, they are not undone immediately. So it's like a doctor treating a patient for 2 years. A doctor will say, let me be more sure and let the medicine continue for a couple of more months, rather than me pulling the plug right now and then, condition deteriorating. So the same is with RBI. I think they will continue with the accommodative stance for a quarter or two, just to ensure that economy gets the last push of support that they require, and post that move towards normalization. So basically, lull for some time, and after that, most likely rates inching up.
Perfect. I think one last question before we wrap up for today. What kind of percentage somebody needs to invest in debt funds in overall portfolio? I think you have given some clues.
So it will go with your age. Let me say ballpark. If you are 30 years, you should be around 20% invested in debt. If you are around 40 years, you should be around 30 to 35% invested in debt. If you are 40, 45, 50 years, let's say between 40 and 50, your debt allocation would have moved between 40 and 50. If you are closer to 60, your debt allocation would have moved 60% or plus. And as you retire, so basically it's like a investment is what I personally think. Of course, your advisors can guide you more correctly, but what I personally see is it's like a aeroplane landing. So aeroplane takes off initially, gains the highest height, which in our normal investment should mean the highest level of risk. And as you move closer to your destination, which I started by saying objectives, you should start reducing your altitude, which means you should start reducing your risk and increase your certainty and finally land. So which basically means with growing age, your debt allocation should increase and equity allocation should reduce. So 30, 40, 50, 60, pick your age, and I think just 100 minus that is a thumb rule for debt equity and debt investment bifurcation. Having said that, always look at your number one, earnings, number two, consumption, number three, liabilities, and put a time period to those liabilities. Draw simple charts on a piece of paper. Just draw a timeline. When do you need what kind of a money? What is your earning? What is your consumption? How much you are saving? Just match that with your age. I think you'll get a very clear, crisper answer.
Thank you so much, Mr. Akhil, and a great analogy with an aeroplane flight. I'm sure with this, all our investors will have a safe landing towards their financial goals. So with this, I think we will wrap up today's session. I think our viewers had a great time learning so much about debt funds and how they can protect the downside by using these great funds. So thank you so much once again, Mr. Akhil, for joining with us and taking all the questions of our viewers. Thanks, Shikhar, for joining in. And we will be back again next week with another interesting topic and another guest speaker. So till then, stay safe, stay happy, and keep investing. Thank you.
Thank you, everyone. Good day.
Thank you, everyone.